Hello friends, welcome to my channel. In today's video, we are going to analyze Oracle Corporation, Oracle, stock which has popped up 35.95% on Wednesday, September 10th, 2025 after reporting their quarterly earnings. So let's go through the earnings. Find out what's good and what's bad about the reported numbers, and then try to figure out if it's a hype or the real deal. Also, at the end of the video, we will compute its fair value using discounted cash flow model and Peter Lynch's EPS growth model to see whether the current market price is undervalued or overvalued. For those who don't know, Oracle Corporation provides enterprise software products and services worldwide. Its products include database management systems, cloud-engineered systems, enterprise resource planning, customer experience, and supply chain management applications, enterprise performance management software, etc. It operates through three segments: cloud license and support, cloud services and infrastructure, and other. So first of all, let's start with the annual revenue growth. Oracle reported a 4% year-over-year growth in revenues. This growth was mainly driven by cloud license and support segment. However, on a sequential basis, that is quarter-over-quarter, revenues declined by 2%. So the sequential decline in revenues, along with a soft guidance from the company, led to a sell-off in the stock immediately after the earnings call. But since then, the stock has been rallying hard. Let's move to the profit margin, and here we have some good news. The gross margin has improved by 80 basis points year-over-year to 87%. The operating margin also improved by 10 basis points to 43%, despite higher operating expenses. And finally, net margin has improved by 5 basis points to 26%. So an improvement in margins is always a good news, and this improvement came mainly due to lower interest expenses, because the company has been able to bring down its debt levels. Now let's check the EPS growth. The earnings per share has grown by 24% year-over-year primarily due to share repurchases. If we exclude the impact of share repurchases, the adjusted EPS would have grown by 11% year-over-year. Next, let's look at return on equity. The return on equity has improved from 18% to 20%, primarily due to lower debt levels and higher net income. Here we can see that the company has been consistently generating higher returns on equity for more than a decade now. And now let's look at the debt-to-equity ratio. Oracle's debt-to-equity ratio has ranged from 8.08 in 2020 to an extreme high as 85.37 in 2023, even dipping into negative territory when shareholder equity turned negative in 2022. As of mid-2025, it's around 4.53, which is still high compared to peers like Microsoft's 0.26 or ServiceNow 0.14. A ratio above 2 is generally considered aggressive. Oracle's peak ratios suggest it relied heavily on debt to fund operations, acquisitions like Cerner, and stock buybacks. The industry average ratio is below 1.0. Negative equity in 2022 means liabilities exceeded assets, a red flag for solvency risk. Alright, now let's do a brief analysis of the balance sheet and the cash flows. On the asset side, total current assets increased from $160.95 billion to $168.36 billion. On the liability side, you can see that total current liabilities have increased primarily due to higher accounts payable. Now let's move to the cash flows. If we look at the operating cash flow, we can see that it has increased from $18.67 billion to $20.82 billion, an increase of 11.52% from last year. Let's move to the valuation, and here we have both good news and bad news. First, let's look at the good news. The forward price-to-earnings ratio has decreased from 23.35 to 18.76, primarily due to a sharp increase in share prices. The forward price-to-sales ratio has also decreased from 7.22 to 5.91. And if we look at the dividend yield, you can see that it has increased to 3.45%. Now let's look at the bad news. The trailing price-to-earnings ratio has increased from 19.17 to 23.69. The trailing price-to-book ratio has also increased from 13.81 to 16.64. And finally, the dividend payout ratio has increased from 44% to 48%. So, an increase in payout ratio is generally not considered to be a good news. because it means that a larger proportion of earnings is being paid out as dividends, which in turn leaves less money for reinvestment in the business. Let's now compute its fair value using two models: discounted cash flow model and Peter Lynch's EPS growth model. For the discounted cash flow model, we will use Oracle's projected financials given by Yahoo Finance. If we look at the projected financials, you can see that Yahoo expects Oracle's revenues to grow by 2.26% over the next 5 years, which is lower than its historical revenue growth of 4%. The projected EP's growth over the next 5 years is 11.8%, which is much higher than its historical EP's growth of 11%. The projected 5-year compound annual growth rate of free cash flow is 11.8%, which again is much higher than its historical growth rate of 8.4%. So let's use these projected values to compute the present value of future cash flows. Here we will use a discount rate of 9%. Right, now let's plug these values into the discounted cash flow formula. So the present value of future cash flows is $33.43 billion. Now we need to add the present value of the company's terminal value. To compute the terminal value, we will use the Gordon growth model. Here we will use a perpetual growth rate of 2%. So the terminal value comes out to be $57.54 billion. Adding the present value of terminal value, we get the total enterprise value of $106.82 billion. Now to compute the equity value, we need to subtract the company's debt from its total enterprise value. So the equity value comes out to be $87.14 billion. Finally, we need to divide this value by the number of outstanding shares to get the intrinsic value per share. So the intrinsic value per share comes out to be $55.72. Now let's compute the fair value using Peter Lynch's EPS growth model. According to this model, the fair value is given by the following formula. So here we will use a growth rate of 11.8%, which is Oracle's projected EPS growth over the next 3 to 5 years. The risk premium will remain the same at 4.2%, and the earnings yield is given by the inverse of the trailing price-to-earnings ratio. So the earnings yield is 4.2%. If we plug these values into the fair value formula, we get $61.67. Now we need to compare these two models. The discounted cash flow model gives us a value of $55.72, whereas Peter Lynch's EPS growth model gives us a value of $61.67. So the average of these two models gives us a fair value of $58.69. And this is much lower than the current market price of $328.33. The closing price on September 11, 2025, during the recording of this video. Based on this, there's too much hype with Oracle, and it's way overpriced. However, there are a few things that we should keep in mind before making any investment decision. Firstly, Oracle's financials are looking good. However, the stock has already rallied a lot. If we look at its price-to-earnings ratio, you can see that it has already reached the pre-COVID level. Secondly, the company's revenue growth is very low, especially when we compare it with other tech stocks. And this low revenue growth is mainly due to the fact that Oracle's cloud business is maturing. Thirdly, the stock has a beta of 0.92, which indicates that it is less volatile compared to the overall market. But still, it is trading at a higher price-to-earnings ratio, which suggests that the market is expecting strong future growth from the company. If these expectations are not met, the stock could underperform in the near term. And finally, Oracle does not have a cash cow business like Meta Platforms has. Meta Platforms generates billions of dollars of cash from Facebook and Instagram, which it uses to invest in its high-risk, high-reward bets, like building the metaverse. But Oracle does not have anything like that. Its bets like autonomous driving and healthcare are still many years away from generating significant revenue. So unlike Meta, Oracle cannot afford to lose money in its bets. It needs to keep investing in these bets while maintaining its existing businesses. And this will require a lot of capital. So I think the recent jump in share price is mainly due to the fact that investors are giving credit to the company for successfully transforming itself from an on-premise software company to a cloud-based software company. But the stock might underperform in the near term due to low revenue growth, especially when compared with other tech stocks. That's all from my side for today. If you learned something new, please make sure to hit the like button. And if you want to see more videos like this, please make sure to subscribe. I'll see you in my next video. Till then, take care.